December 31st, 2025. Warren Buffett, age 95, his final day as Berkshire CEO, sells his last bank stock, complete exit, 24 billion dumped in 9 months, 354 billion in cash, the largest evacuation in his 70-year career. 14 years ago, same bank, trading at $6. Financial system collapsing, Buffett saves it with 5 billion, calls it long-term. I have confidence, he says. Now sold at $43, gone, evacuated, and here's what terrifies Wall Street. He's done this exact move twice before. Right before the dot crash, right before 2008. Both times, banking crisis followed within 18 months. His timeline now, 2026. The 95-year-old oracle just made his final bet. What does he see coming that you don't? August 2011, Bank of America trading at $6 a share. The financial system on edge, European debt crisis spreading like wildfire, U.S. credit rating just got downgraded for the first time in history, Lehman Brothers still fresh in everyone's memory, the whole banking sector looks like it's heading for round two. Warren Buffett makes the call, $5 billion in preferred shares, 6% annual dividend. Warrants to buy 700 million common shares at $7.14. The deal of the decade. He goes on CNBC the next morning. I have confidence in Brian Moynihan. I have confidence in the franchise. Bank of America is a strong, well-led company. The market exhales. Bank of America stabilizes, then climbs. 2013, $12. 2017, $25. 2021 hits 48 during the rate spike. 2024 settles at 43. That's 2 times tangible book value, the highest valuation since the 2008 crisis, outside of that 2021 anomaly when everyone thought rates would stay low forever. 14 years, 7 times return on the warrants, over 10 billion in dividends collected. The perfect Buffett trade. Buy low, hold long, win big. And then he starts selling, not trimming, selling. Q1, 2025, 150 million shares gone. Q2, 220 million shares dumped. Q3, 315 million shares liquidated by December, from 1.1 billion shares down to 690 million. That's a 44% cut. 31 billion still on the books, but the trajectory is clear. Complete exit in progress. Not just Bank of America. Look at the full picture. New holdings. The Brazilian digital bank Berkshire, bought in 2021. Buffett loved the founder, loved the model. Digital banking for emerging markets, 200 million customers, stock tripled, then 2025 complete exit, 250 million in profit locked and gone, Capital One trimmed position by 60%, Wells Fargo already fully exited by 2023 after the fake account scandal, US Bancorp reduced every single bank stock, either gone or going. Berkshire's official statement to shareholders. We are anticipating higher corporate tax rates in the future and are locking in gains at the current 21% rate. Estate planning, tax efficiency, boring, responsible wealth management. Sure. Except here's what they don't tell you. Bank of America forward PE ratio 12.7. That looks cheap compared to the S&P 500 trading at 22 times earnings. Value investors everywhere are saying Buffett's crazy. Banks are on sale. But September 2024, the Fed cuts rates for the first time since 2020, then again in November, then December. Every single 25 basis point cut costs Bank of America $800 million annually in net interest income. That's the spread compression. Banks borrow short, lend long. When the Fed cuts, deposit rates stay sticky, but loan rates drop fast. The margin collapses. Bank of America's net interest income 2023, 57 billion. 2024, 52 billion. Projected 2026, 48 billion. That's a 15% drop in 2 years. Suddenly, that PE of 12.7 on 2024 earnings becomes 18 or 20 on 2026 earnings. Not cheap, expensive, a trap. And Buffett knows this math better than anyone. His 2011 shareholder letter, he wrote, banks that have low-cost deposits essentially have float-free money to invest. That was the thesis. Deposits cost nothing. You lend them out at 5%, you print money. But 2025 reality, deposits cost 5%. High-yield savings accounts everywhere. Money market funds paying 5%. The free float is gone. The model is broken in this rate environment. Multiply that across the sector. Every 25 basis point cut, 50 billion in annual earnings disappear across all US banks. And the Fed's cutting rates because, what? Because the economy is strong? No. Because recession risk is rising. And when recession hits, Those net interest income losses get multiplied by credit losses, loan defaults, provisions, write-downs. Same quarter Buffett's selling Bank of America. He buys $4.3 billion of Alphabet. Not financials, tech, infrastructure, search, cloud AI, assets that generate cash flow regardless of interest rates. That's not tax strategy. That's sector rotation based on a macro thesis. He sees the banking model breaking and he's exiting before the rest of Wall Street figures it out. This is the bookend trade. 2011, he saved Bank of America at $6. Bottom signal 2025, he's selling at 43. Top signal, same playbook he ran in 1999 before the dot crash. Same playbook in 2007 before the financial crisis. And both times he was early. But he was right. If this video is helping you see the pattern mainstream financial media is completely missing, hit that like button and subscribe, because what comes next explains exactly what Buffett is positioning for with that record cash pile. And it's bigger than just banks. $354 billion. Let that sink in for a second. That's more than the GDP of 170 countries, more than Portugal, more than Vietnam, more than New Zealand and Pakistan combined. Berkshire Hathaway is sitting on more cash than most nations generate in a year. And it's not random. This is accumulated firepower, 12 consecutive quarters as a net seller. Quarter 1, 22-23, $130 billion in cash. Quarter 4, 2024, $325 billion. Quarter 4, 2025, $354 billion. After Warren hands over the CEO role to Greg Ale, the largest war chest in corporate history, locked and loaded. Here's the question nobody's asking. Why pile cash when the S&P 500 is at all-time highs? When everyone from Wall Street to your uncle is saying cash is trash in an inflation era, when Bitcoin's ripping, tech stocks are flying, everything's going up because Buffett's not playing the same game as everyone else. He's playing pattern recognition, and he's done this before. Twice. First time 2006 to 2007, Buffett starts selling, trimming positions, building cash. By mid-2007, Berkshire's sitting on $48 billion. Everyone thinks he's lost it. The market's roaring, housing prices going vertical, subprime mortgages packaged into AAA-rated bonds. Goldilocks economy, they called it, September 2008. Lehman Brothers collapses, the financial system freezes, panic, credit markets seize up, stock market drops 40% in 6 months. Banks are insolvent. Nobody has capital except Buffett. October 2008, he deploys. Goldman Sachs, $5 billion, General Electric, $3 billion. Harley-Davidson, Tiffany's Swiss Re, $15 billion, in total buying blue-chip companies at Depression era, prices, terms, 10% dividends, warrants at massive discounts. Goldman Sachs deal alone, he makes $2 billion in profit within 3 years. He didn't get lucky. He prepared. He saw the housing bubble. He saw the leverage. He saw the pattern. And he waited with cash until everything went on sale. Second time, 2019. Buffett's building cash, again selling stock by early 2020, $208 billion. Then COVID hits. March 2020, market drops 34% in 3 weeks. Fastest crash in history. Panic selling everywhere. And Buffett hesitates. April 2020, shareholders meeting. He says, "We haven't done anything because we don't see anything attractive." May, June, still holding cash. By July, the Fed's printed $6 trillion, markets already recovered. He missed it. One of his rare mistakes. The cash was ready, but he waited for a better price that never came because the Fed intervened too fast. Lesson learned. When the opportunity comes, you deploy fast. Don't wait for the perfect pitch. Wait for the crisis, then swing hard. Now, 2025 going into 2026, $354 billion in cash. That's 2.5 times more than 2020, 7 times more than 2008. This isn't preparation for a correction. This is preparation for a systemic event. What's different this time? 2008 was housing and banks, easy to identify. 2020 was pandemic and stimulus. Obvious 2026 is what? He knows something. And whatever it is, it's bigger than a 10 or 15% pullback. Look at what he's buying. The only major purchase in 2025, $4.3 billion in Alphabet. Not banks, not real estate, not cyclical industrials, tech infrastructure, the one sector that works in any interest rate environment. That's the tell. He's rotating out of rate-sensitive assets and into things that generate cash flow regardless of macro conditions. The Oracle doesn't hoard cash because he's bearish on America. Berkshire still holds $270 billion in Apple, Coca-Cola, American Express. He's not selling everything. He's rotating out of financials, out of rate-dependent models, into tech, into cash, preparing for the moment when assets go on sale. And here's the thing, when Buffett deploys that $354 billion, it won't be into an index fund. It'll be into specific companies at 50 cents on the dollar, banks trading at book value, industrials at single-digit PE ratios, the kind of deals that only show up during systemic stress. He's not bearish, he's patient. And this time, the sale he's waiting for is in the banking sector, specifically the same sector he just exited completely. September 2024, the Federal Reserve cuts interest rates for the first time since 20 hogs and 20. 50 basis points. Markets celebrate. Bank stocks rally. Finally, the pivot everyone's been waiting for. Lower rates mean more lending, more mortgages, more economic activity. Good for banks, right? Warren Buffett sells harder. Because here's what the market doesn't understand. Banks make money on the spread. They borrow short-term deposits and lend long-term mortgages and commercial loans. The difference between what they pay depositors and what they charge borrowers, that's net interest margin. That's the profit engine. 2022 to 2023, Fed funds rate at 5.5%. Banks had a 400 basis point spread. Golden age for banking. Deposits still cost almost nothing because people are lazy. Savings accounts paying 0.5%, but new mortgages going out at 7%. New commercial loans at 8%. Banks are printing money. Bank of America's net interest income, $57 billion in 2023. Record profits across the sector. Then the Fed starts cutting. September 2024, 50 basis points. November, another 25. December 25 more. By early 2025, Fed funds down to 4%. Forecast for 2026, 3.5%. What happens to that spread? Deposits are sticky on the way down. High-yield savings accounts still paying 1.5% because banks need to retain deposits. Money market funds paying 5%, but loan rates drop fast. New mortgages at 5.5%, refinancings at 5%, commercial loans at 6%. Suddenly, that 400 basis point spread compresses to 250. Bank of America's net interest income, $57 billion in 2023, $52 billion in 2024, projected $48 billion in 2026. That's a 15% drop in the core profit engine. Every 25 basis point rate cut, $800 million gone annually. Multiply across the sector. Every cut, $50 billion in earnings disappear. Now look at valuation. Bank of America PE ratio 12.7. Everyone says it's cheap. S&P 500 trades at 22 times, but that 12.7 is backward-looking. That's based on 2024 earnings. Forward PE on 2026 earnings, when net interest income is down 15% closer to 18 or 20. Not cheap, it's a trap. And here's where Buffett's 2011 thesis breaks. His shareholder letter that year, he wrote, "Banks that have low-cost deposits have float, essentially free money to invest. That was the edge. Deposits cost nothing. You lend them at 5 or 6%. Free cash flow. But 2025 reality, deposits cost 4%. The float isn't free anymore. It's expensive. And when your funding cost is 4.5% and you're lending at 5.12%, that 1% margin barely covers operating costs and credit risk. The model is broken. Worse, rate cuts don't happen because the economy is strong. They happen because recession risk is rising. And if recession hits while banks are already dealing with margin compression, you get the multiplier effect. Rate cuts plus recession equals catastrophic. Loan defaults spike, credit card defaults, commercial real estate defaults, auto loan defaults. Banks have to build provisions, reserves for expected losses. That hits earnings even harder. Net interest income down 15%. Credit provisions up 50%. Suddenly banks aren't making money, they're losing it. We've seen this pattern before. 1990 to 1991. Fed cuts rates to fight recession. S&L crisis hits. Over 1,000 banks fail. 2000 to 2001. Fed cuts after dot crash. Regional bank crisis. Dozens collapse. 2023 mini version. Silicon Valley Bank signature. First Republic. All gone in 72 hours because rate shock destroyed their balance sheets. 2026 setup looks worse. Yield curve inverted for 18 months. Longest inversion since 1978. That's the recession warning. Commercial real estate losses already starting. Office vacancy rates at 20% nationally, 30% in San Francisco and New York. 5 trillion in commercial loans maturing 2024 to 2027. Refinancing wall. Properties that borrowed at 3% in 2019 now renewing at 7. Can't cash flow. Defaults coming. And banks hold 70% of commercial real estate loans. Not pension funds, not private equity banks, regional banks, especially when those defaults hit. It's 2008 all over again, but in slow motion. Buffett sold Bank of America at $43. When net interest income craters, when recession hits, when commercial real estate defaults roll through, that stock will be at 28, maybe 25. And that's when he'll buy it back. He's not pessimistic. He's playing the cycle. Sell high, wait for the crisis, buy low. That's the pattern. That's always been the pattern. Buffett selling banks isn't just about interest rate math. It's about 4 converging crises that are going to hit the banking system simultaneously in 2026. And almost nobody sees it coming. Stage 1 commercial real estate time bomb, 20 trillion market, 5 trillion in loans maturing between 2024 and 2027. Office buildings, shopping malls, hotels, properties financed when rates were at 2 or 3%. Now refinancing at 7. The math doesn't work. Office vacancy rates nationally 20%, San Francisco 32%, New York 29%. Work from home killed demand. Buildings worth half what they were in 2019. But the loans are still at full value. 25 banks already took 150 billion in commercial real estate losses. Write-downs, provisions, defaults, 2026 and 2027, another 300 billion coming. And here's the key. Regional banks hold 70% of those loans. Not JP Morgan, not Bank of America. Small and mid-sized banks that don't have the capital buffer to absorb losses. Stage 2, regional bank fragility. March 2023. You saw the preview. Silicon Valley Bank collapsed in 48 hours. Signature Bank gone. First Republic seized. Why? Uninsured deposits, accounts over $250,000, business accounts, startup accounts, wealthy individuals. They fled overnight to the big banks. 2026 risk 180 regional banks still sitting on unrealized losses. Bond portfolios they bought in 2021 and 2022 when rates were 0. Now those bonds are underwater. Fed rate cuts help, but slowly. If recession hits before those bonds recover, the banks are insolvent on a mark-to-market basis. And when crisis starts, depositors panic. They move money from regional banks to JP Morgan, to Bank of America, to the giants they think are too big to fail. But here's what Buffett knows. Even the big banks aren't safe this time, because stage 3 is already in motion. Stage 3, deposit flight to money markets. 2023 to 2025, $6 trillion moved out of bank deposits into money market funds. Why would you keep cash in a checking account earning 0.5% when a money market fund pays 5%? It's free money just for moving it. Banks are hemorrhaging deposits, and deposits are the lifeblood. That's the cheap funding. When deposits leave, banks have to borrow from the Fed discount window or issue bonds at higher rates. Their cost of capital goes up. Margins compress even more. 2026, even if the Fed cuts to 3.5%, money market funds will still pay 4%. The deposit flight continues, banks lose their funding advantage. The model that Buffett loved in 2011, the float, the free money, it's gone. Stage 4, regulatory tightening. Basel III endgame rules. 2025 to 2026, new capital requirements kick in. Banks have to hold 20% more reserves. Tier 1 capital ratios go up. That means less lending capacity. Even without a recession, even without defaults, banks have to shrink their balance sheets just to meet the new rules. Buffett's exit timing right before these rules fully take effect. He knows that when banks have to hold more capital, they make less money. Return on equity drops. And Wall Street punishes that with lower valuations. Put it all together. Commercial real estate defaults rolling in, regional banks on the edge of insolvency, deposits fleeing to money markets, regulatory requirements forcing balance sheet contraction, and on top of all that, recession risk at the highest level since 2008. This is why Buffett's exit is complete, not partial. He's not trimming, he's evacuating. Because when these 4 stages hit simultaneously, it's not a correction. It's a systemic reset. Same pattern as 2007. He sold banks in 2006 and 2007. Bought back in 2009 and 2011 after the crisis bottomed. Same pattern as 2000. Sold financials in 1999. Bought back in 2002 and 2003. This is the 3rd cycle. And this time, he's not even keeping a toe in the water. Complete exit. The mainstream narrative. Buffett's selling for tax reasons. But here's the reality. He helped build this financial system in the 1990s and 2000s. He saved it in 2008 to 2011. And now he's exiting before it resets. When the architect leaves the building, you don't ask why, you follow. Elite money already knows. They're positioned. You have 6 to 12 months before this becomes obvious to everyone else. And by then, it'll be too late. Let's close the loop. 2011, Bank of America at $6 a share. Buffett puts in $5 billion. Bottom signal, the market follows him in. The stock climbs for 14 years. 2025, Bank of America at $43. Buffett sells his last shares. Top signal, and the market still hasn't figured it out yet, but they will. 2026, banking crisis hits. Commercial real estate defaults, regional bank failures, deposit runs, and Bank of America 28s, maybe lower. That's when Buffett buys back in. Not a guess. Pattern recognition. So what does he know that you don't? He knows the interest rate math. Below 4% Fed funds with 2% inflation, banks can't make money. The spread compresses. Net interest income collapses. The model breaks. He knows commercial real estate losses haven't fully hit balance sheets yet. $150 billion in 2025 was just the first wave. $300 billion more coming in 2026 and 2027. Regional banks can't absorb that. Contagion spreads. He knows regional bank crisis 2.0 is coming the moment recession is officially declared. And with the yield curve inverted for 18 months, that recession is not a question of if, it's when. He clears throat, knows regulatory capital requirements make banking less profitable for the next 5 years minimum. Basel III endgame forces banks to hold 20% more reserves, less lending, lower ROE. Wall Street reprices the whole sector down. And most importantly, he knows that when these four factors converge, it's not a 10% correction. It's a 50% reset. And the time to exit is before that reset, not during. So what's he doing with that $354 billion? Waiting. The only major buy in 2025, $4.3 billion in Alphabet. Tech infrastructure that works in any interest rate environment. Not banks, not financials, not anything tied to the rate cycle. He's positioning for the biggest buying opportunity since 2008 and 2009. When banks trade at book value, when credit card companies are at single-digit PE ratios, when the whole financial sector is in the penalty box and nobody wants to touch it, that's when he deploys. That's when he makes the real money. This is not prediction. This is pattern recognition. The same pattern that moved capital out of banks in 2007, the same pattern that moved capital back in at the 2009 bottom is executing right now in real time. And most people are watching it happen without understanding what they're seeing. Now, here's the reframe. Buffett is not bearish on America. Berkshire still holds Apple, still holds Coca-Cola, American Express, sees candies. He's not liquidating everything and moving to cash. He's rotating out of banks specifically because in this rate environment, with this regulatory backdrop, with this commercial real estate exposure, the math doesn't work. And when the math doesn't work, even the Oracle of Omaha doesn't fight it. He exits, he waits, and he re-enters when the price is right. Your opportunity is not to copy what he sold. Your opportunity is to watch what he buys next. Because when he re-enters the banking sector, and he will, that's the signal. That's when the crisis has bottomed. That's when the real generational wealth gets made. Not before 2026 to 2027. Buffett will deploy $100 billion plus at a 50% discount to today's prices. You want to know when that happens? You need to be watching. Warren Buffett is 95 years old. He has seen 14 recessions. He has navigated 7 banking crises. He saved Bank of America once, and now he has sold his last bank stock. He is not guessing about 2026. He is not worried about 2026. He is prepared for 2026. The question is, are you subscribed right now if you want to know exactly when Buffett re-enters the banking sector? Because that is when the real money is made. Not at the top, at the bottom. And comment below, are you holding bank stocks right now, or did you follow the oracle and exit already?